All right, let's jump right in. Today we're going to break down a super simple, rule-based strategy for trading gold ETFs. This comes straight from our source material, and the promise here is a clear, straightforward way to trade without any complex indicators. So let's get to it.
So, here's the big question, right? Can you really trade the gold market and be profitable without plastering your charts with all sorts of complicated lagging indicators? Well, the source material we're digging into today says absolutely. In fact, it argues you probably should.
You see, the whole foundation of this strategy is something our source calls institutional logic. The idea is, instead of guessing or trying to predict the future, you just learn to follow the smart money. We're talking about the big institutions whose trades are so massive, they're the ones that actually move the market. We're going to break down exactly how this strategy aims to do just that, step by step.
Okay, first up, gold's institutional playbook. Before we get into how to trade, we need to be crystal clear on the what. This section is all about the setup. Think of these as the non-negotiable rules of the game.
And what's really striking here is just how simple this is. We're focusing on any liquid Indian gold ETF, that's an exchange-traded fund, which you can buy and sell just like a stock. The time frame, strictly the daily chart. No peeking at anything else. It's a swing trading style, so you're looking to hold a position for anywhere from 3 to 10 days. And, well, you see it right there at the bottom. The most important part, absolutely no indicators. This is all about pure price action.
So, let's talk about the market's secret rhythm. This is the core theory, the big idea. Our source argues that gold's price movements aren't just random noise. Nope, they actually follow a predictable cycle, and that cycle is driven by those big institutions. Understanding this rhythm is the key to unlocking the whole strategy.
And here it is, the 4 phases laid out perfectly. It all starts with accumulation. This is that quiet, sideways period where the big players are slowly, quietly building their positions. Then, that's followed by expansion. This is the big, explosive trend that we all want to catch. After that, you get distribution, where the move kind of runs out of steam. And finally, a correction, where the price drops back down. Our entire strategy, it's all about one thing, spotting the end of stage 1, right before stage 2 kicks off.
So, here's the crucial takeaway. Your job as a trader using this method is actually really simple. You just have to patiently wait for that boring, quiet accumulation phase to be over. You're not trying to follow a trend that's already started. You're trying to get in right as the explosive part is about to begin. That's how you position yourself ahead of the herd.
All right, now for the fun part, the actual playbook. We're going to walk through the exact 5 steps to spot the setup and pull the trigger on a trade. This is where all that theory turns into a concrete, actionable plan.
Step 1, we're on the hunt for what the source calls the quiet zone. This is the fingerprint that institutions leave behind when they're accumulating. You're looking for price to be stuck in a tight sideways range for about a week, give or take. The candles will be small, there's no obvious trend, and the highs and lows are all kind of overlapping. Honestly, it should look pretty boring on the chart, and that's exactly what we want.
Okay, once you've found that quiet zone, step 2 is about as easy as it gets. You just draw 2 horizontal lines. One connects the absolute highest high of that period, and the other connects the absolute lowest low. That box you just drew, that's your institutional control range. And as long as the price is inside that box, you do absolutely nothing.
Now this is the trigger. The entry signal's a little more than just a simple breakout. First, you need a strong daily candle to actually close above the top of that range. But here's the crucial part. You have to wait for the next day for confirmation. The price has to hold above that range. Our source calls this acceptance, and it's a huge clue that the breakout is for real.
Look, any professional strategy needs a non-negotiable exit plan for when a trade goes wrong. Here, you've got 2 very clear options for your stop loss. The standard way is to stick it just below the low of that big breakout candle. If you want to be a bit more conservative, you can place it just below the high of the old range you drew.
And here's the logic behind that stop-loss placement. It's so simple, but so powerful. The core belief is that if big institutions are really behind this move, if they're the ones buying, they are going to defend that breakout level. Price should not be allowed to fall back inside that accumulation zone. If it does, something's wrong, and you want to be out.
So you're in the trade, it's moving in your favor. How do you get out with a profit? Well, your first minimum target should be a move equal to the height of that range you drew. After that, you can start trailing your stop loss to lock in those gains. But our source is really clear. Gold tends to move fast after this setup. If you see a big, ugly rejection candle, or if the price just goes dead and moves sideways for a few days, that's your cue. It's time to take your profit
and go.
A great entry strategy is totally worthless without professional discipline. So now let's talk about the rules that separate the pros from the amateurs. The rules designed to do one thing: protect your capital. This is what gives you staying power in the market.
And if you only remember one thing from this whole explainer, please let it be this: never, ever risk more than 1% of your total trading capital on any single trade. Seriously, this isn't just a suggestion, it is the absolute foundation of long-term survival.
The source is also super clear about what not to do. Don't trade inside that choppy sideways range. Don't try to be a hero and guess the breakout before it happens. Don't clutter up this pure price signal by adding indicators to confirm it. And please, don't feel like you have to be trading gold every single day. Patience is the real weapon here.
So, you might be asking, why does this super stripped-down, indicator-free approach actually work? What's the secret sauce? What's the logic that gives this simple strategy its power?
Well, when you boil it all down, it really comes back to these 4 things. First, it's aligned with how institutions actually behave. Second, by ditching indicators, you get rid of lag, and you're reacting to what price is doing right now. Third, this pattern of accumulation and expansion, it's timeless. It happens over and over, so it works in any kind of market. And finally, because every single step is defined by a rule, it helps you take your own emotion out of the equation.
And this really brings it all home. The goal isn't to be busy, it's to be profitable. The source argues that if you truly master this one single setup and just execute it well 2 or 3 times a month, that's more than enough to be successful trading gold ETFs.
I'm going to leave you with this final thought from the source because it just nails the entire philosophy here. Simplicity is not a weakness. Simplicity is what the institutions, the smart money, actually use. The goal isn't complexity, it's effectiveness. And a lot of the time, the most effective tools are the simplest ones.